Hello, welcome back. Here is Ali Talabi, and this is module 14. In this module, we are going to talk about the evaluation of their portfolio or investment. So we'll learn how you can evaluate your performance of your investment. In the first module, we'll talk about the three major measurements. So we'll talk about the Sharpe ratio, Treynor ratio, and Jensen's Alpha. In the second lesson, I will expand our argument regarding Jensen's alpha, and I will show you a step-by-step how actually you can calculate alpha using the regression. And also, I will talk about the information ratio. And we'll wrap up our session by looking at different measures, and we'll compare and contrast them. So let's start our first lesson. So when it comes to any investment, it's kind of irrelevant to find the performance of your portfolio or your investment. So the performance evaluation is a term which is referring to assessment of your performance and finding the appropriate return and risk for any investment. We learned in in one of our lessons that the risk and returns are two most relevant topics in the world of investment. So when we talk about the performance evaluation, we are referring to capturing the effect of those factors, risk and returns, in our evaluation. So when you are going to evaluate the performance of the money manager, you are going to ask yourself that how well a manager is actually is able to reach a balance between the return and the risk. And for sure, you prefer the performance of the manager who is providing the higher return with the lower risk. And also, you're asking yourself that how well a manager is performing and over time. And is the manager able to consistently earn an excess return? In other words, is the person able to beat the market? So that's the argument we have to consider, because you can find a manager maybe just once in a while just perform much better than the market, but it doesn't mean that person is a good money manager. You have to track the performance of this person to see whether he's able to actually gain a consistent excess return. So we talk about the risk and return as two measurements. So sometimes if you just look at the return itself, you might get wrong information. So the return itself is also called raw return. What is raw return? Raw return of the security or investment or portfolio, that's a total percentage return on a specific investment. So if you just look at the return, you can get some idea about the performance. But we call that raw return because it provides just one aspect of the performance, which is also called the naive performance evaluation measure, because it ignores the risk factor in any investment. So we can say the usefulness, the application of the raw return on any investment is very limited. So we have to consider the risk factor as well. So that's why we are more towards those factors which capture the impact of both risk and return. One of the most important ones is called Sharpe ratio, which is also called reward to risk ratio. What is that ratio? The ratio actually compared the excess return of the investment with the risk. And the risk is measured by a standard deviation. We learned that the standard deviation is used to measure the total risk, both systematic and unsystematic risk. So the Sharpe ratio, and for sure that's a ratio, it's dividing actually the excess return, also called the security risk premium. What is the security risk premium? That's a return for a specific security or investment or portfolio minus the risk-free rate divided by the total risk, which is measured by the standard deviation of that investment. And for sure, if you are the manager, you want just to increase your Sharpe ratio. You want to have higher reward to risk ratio because it means that for the given risk, you are able to gain more return. However, as we discussed earlier, and when we talk about the CAPM capital asset pricing model, I mentioned that the standard deviation by itself, it's not a good indicator of the risk, because if you are the good manager, you should be able to diversify your portfolio. So we mentioned another measurement which was called beta. Now, if you replace the standard deviation with beta, you can go with the new measurements to measure your performance, which is called Treynor ratio. So Treynor ratio is also a kind of reward to risk ratio. However, it considers just the systematic risk of your investment. So again, the risk premium or the security risk premium divided by the beta. Similar to the Sharpe ratio, you want to have the higher ratio because it shows that you can earn higher return or higher risk premium given the risk of your investment. So the third approach to measure the performance of your investment is called Jensen's Alpha, or sometimes it's just called Alpha. I'm sure that you remember the notion of CAPM from module 13. So we mentioned that based on CAPM, the expected return of any investment is based on the risk, which is measured by beta. Here is the formula which we mentioned before. So the CAPM risk adjusted or estimated return is based on the risk-free rate and market risk premium and beta. And for sure, if the beta is higher, you are expecting to have higher return. So we can calculate the expected return based on this formula. However, if your actual return is different than what CAPM is estimating, there should be a gap. So the gap between the actual return and the return, which is calculated based on CAPM, is called alpha. Remember, this alpha might be positive or negative. And for sure, as the manager, you're looking for the positive alpha because it means you are getting more than what the model is telling you based on the risk. Or in other words, you are getting higher return than the return which is based on the risk. Now, how it works, so let me explain the alpha using a graphical explanation. So let's talk about alpha using the security market line. So as we learned in module 13, we mentioned that the CAPM is showing the relationship between the beta and expected return. So here is our beta, here is the expected return, and also I demonstrated the security market line, which is showing the relationship between the beta and expected return. Here is your risk-free rate. The beta is 0, but still you are getting some return. For the market, if you are considering the beta of 1, you should expect as much as the market is giving you. Here is the expected return on the market. Now, the actual return for any specific investment might be different than what the SML is telling you. The SML is just showing this connection, this relation, and the CAPM is showing actual equation of this relationship. Now, let's assume that you have a stock which is actually here. So let's call this stock A. So you can estimate the beta for this stock. So this is the beta of stock A, and also here is the expected return for this stock. So let's call expected return of A. However, based on the CAPM, your estimated expected return of this asset should be here. So it should be much higher than actually you are getting. So you are getting less than what SML is telling you, what CAPM is telling you. So here we'll say that you are getting, so let me write, so you are getting a negative alpha. So your alpha here is negative. So your Jensen's alpha is negative. So you are underperforming than what CAPM is telling you. So that's how you can measure the performance of your investment. Or if you are able to find, let's assume that you were able to find another asset. So let's call this B, which is above the line. So for this B, with the same argument, here is the beta of B, and here is the expected return of the B. Here is what the model is estimating. to get. It's very similar to expected return of A. However, actually you are getting more than what the model is telling you. So here you will have the positive alpha, which is good. So, and you like it because it's showing that you're actually getting more than what the model is estimating. So this is a good results based on the positive alpha. And for sure, you might find some investment which are actually falling over the line. So just across that security market line. In this case, the alpha becomes 0. So these are not overvalued or undervalued. In this case, we'll say that the security is actually correctly priced. So based on the Jensen's Alpha, you should follow and find those type of investments and portfolios which are giving you positive alpha. So if as a manager you are getting the positive alpha, it means that you are performing well. That's it for today. Thank you very much. Talk to you soon in the second lesson, module 14. Till then, have a wonderful day. Take care. Talk to you soon. Here is Ali Talabi.